Happy Friday out there, folks. This is Darius Dell here to present our macro minute for Friday, May 20th, 2022. Starting with markets, we have stocks up this morning, commodities mixed with industrial metals leading on the China loan prime rate cut, and obviously coming out of lockdowns as well. At least there's speculation that they're going to start to ease zero COVID restrictions. Crypto up, dollar flat, global bond yields up. Market moving headlines this morning, we got a decent amount of them. So starting in the U.S. here, Treasury Secretary Janet Yellen rejected the idea that the Fed or its counterparts, and mind you, this is former Fed Chair Janet Yellen as well. She rejected the idea that they should boost their inflation targets at a time when living costs are surging. She doesn't see that as an immediate reason to change. The challenge, per her quote, is to meet the inflation targets that have already been established. So that is a signal, in our opinion, that the Federal Reserve ambulance sirens that we're all waiting to hear, the BTFD and risk assets, are not yet here and unlikely to be met sooner, unlikely to be perpetuated sooner by the Fed sort of throwing in the towel on their inflation objective. Chinese banks, as I mentioned, cut their long prime rate by a record amount, 15 basis points to 4.45% for the 5-year loan prime rate. That's a bigger than estimated cut. It was a signal that as China, as we've talked about in this program, and then obviously in our research, as China comes out of the peak COVID lockdowns, you're going to start to see a more accumulation of fiscal and monetary easing. Because again, there's no point in easing if you're going to have 30% of GDP by population and geography under lockdown. So we'll talk a little bit more about China, our thoughts on that, when we think it's appropriate to start taking risk in Chinese markets and related assets. Japan's inflation accelerated pretty sharply in April to up 2.1% year over year. It finally got over the BOJ's target, but this is the fastest inflation rate we've seen in 14 years in Japan. This is inflation excluding fresh food. I'm not sure why in the hell a central bank would target inflation excluding food because human beings eat food, but that's neither here nor there. That's not what we're here to talk about here in Macro Minute. But anyway, we continue to believe that the BOJ is very unlikely to abandon yield curve control, even with this print. In terms of our projections for the Japanese inflation, updated projections, as you know, our models are constantly updating in real time, sucking in all the incremental data. Our projections on Japanese inflation don't suggest that we're going to see a change in the BOJ's policy, nor do we expect to see an yen intervention, which Mr. Yen himself, Isuke Sakibara, did I say that right? Sakakibara. I always mispronounce his name, but anyway, this is former vice minister of Japan. He's kind of the guy to go to in terms of understanding Japanese yen intervention cycles, and he seems to agree in our view that this will not be an appropriate level to short to buy the yen relative to the dollar on intervention speculation. So we'll talk about Japan as well in today's leadoff morning note, on providing our updated projections there and our thoughts on Japanese assets, et cetera. And then lastly, you have consumer confidence in the UK fell to the lowest level in almost 5 decades. This is, there's nothing else to say. I mean, clearly, inflation is destroying consumer confidence, not just in the U.S. economy, but globally for most Western economies as well. You have a lot of emerging market economies that are struggling with food and energy prices as well. And so we continue to believe we're at a very adverse phase of the liquidity cycle globally. We spent a lot of time sort of helping investors fully understand and contextualize where we are in the liquidity cycle in our latest macro scouting report that was out last Tuesday, our May 22 macro scouting report. Definitely go check that out if you haven't seen it. Slides 77 through 82, slides 89 through 100, and slide 109 specifically help investors contextualize specifically and exactly where we are in the liquidity cycle, when we expect it to inflect, and ultimately sort of the resulting impacts we're likely to see along the way, both to the downside and then eventually to the upside. Big movers this morning. It's all China driving things this morning, and OPEX as well. Shanghai Composite up 1.6% to up 2% week to date. Germany's DAX index up 1.9% to basically flat week to date. So that's it. Taking it to our charts here, our volatility adjusted momentum signals in probable ranges. Bloomberg Dollar Index, that's bullish VAM still. It's had a nice little correction here, selling off to the lower bound of its probable range with 3% immediate turn or upside to the upper bound of its probable range. Gold broke down to bearish VAMs this week. Now, as you see that, we now got a negative distribution in the probable range skew. It's got 4.8% of downside versus 1.7% of upside here. 10-year nominal treasury yield, bullish VAMs here. It's at the lower, but sold off to the lower boundary of its probable range here, minus 4 basis points of downside with 45 basis points of upside. We got to see, looks like the slope might be changing a little bit here. Now we're in this phase a little bit, we've got to keep our eyes here on pretty closely on rates. Eventually, the market's going to start to price in the impact of a slowing consumer, slowing business cycle on inflation. We're not quite there yet in terms of seeing broad-based inflation expectations break down, but we are starting to see, they're starting to see some cracks at the margins. This week we had 2-year USD inflation swap rates break from bullish VAMs in our global macro risk majors to neutral VAMs. We also had Euro 5-year forward inflation swap rates break to neutral VAMs as well. So we're keeping our eye closely. Things are starting to change a little bit at the margins, but we're not seeing it yet, broadly speaking, in terms of being ready to fully take up our exposure to duration risk. High yield OAS bullish VAMs, minus 58 basis points of downside, 26 basis points of upside here. S&P 500 bearish VAMs, minus 6.3% of downside versus 5.4% of upside here. VIX neutral VAMs. What's our per bound in S&P? So we're now at 4150 now. So we couldn't get 4200. I would have loved to short a bunch of stocks at 4200. So hopefully we get OPEX into 4150. I'd love to see that next week on the other side of OPEX. But again, there's no guarantees in financial markets. You just have to manage risk accordingly to the evolving distribution of probable outcomes. And if you don't know what those evolving distribution of probable outcomes are, then definitely subscribe because we'll help you figure those out in real time. Minus 22% of downside in the VIX here versus 33% of upside. NASDAQ 100 still bearish VAMs, minus 8.5% of downside versus 7.1% of upside. So a fair fight there. Russell 2000 bearish VAMs, less of a fair fight, only 4% of upside versus 10% of downside. Bitcoin bearish VAMs here, minus 20% of downside, 10% of upside, so less of a fair fight. Ethereum bearish VAM still minus 23% of downside versus 17% of upside. So crypto still moving in the wrong direction. What a phenomenal. I mean, this our signal on big. I'm not a tech guy. I don't know anything about the blockchain, or at least not more than the average person in TradFi or whatever we want to call ourselves. The Wall Street people. But this Wall Street person has had quite the call on Bitcoin and Ethereum and crypto broadly, really, since going back to the fall of last year. We obviously made some pretty explosive calls to the upside going back to the fall of 2020 as well. So I think I know what I'm doing here. I'm not saying I know everything there is to know about blockchain, and certainly we never will. But I think, very clearly, it's pretty clear that all of you are suffering drawdowns in the cryptocurrency ecosystem, and we're certainly not here to make fun of anyone. We just want to help educate people and help prepare them for the next cycle, the next drawdown, the next phase and inflection in the liquidity cycle that can actually help you generate returns or manage risk, because that's what we're trying to do here. It's trying to help investors take all the information that's in this big brain and put it in your portfolios and your P&L and help it generate some capital as a function of that. Shanghai Composite bearish VAMs here. I talked about this. It looks like it wants to break out to neutral VAMs. This is what happens when you start hugging the upper or lower boundary of the probable range. These are two quantitatively linked processes. Bearish VAMs have negative skew in the distribution. Neutral VAMs have Gaussian skew, and the bullish VAMs have a positive skew in the distribution. So we might start to see some phase transition in Shanghai Composite, et cetera, as an inflection, both in the Chinese liquidity cycle and also an inflection in the Chinese growth cycle as well, as the country comes out of lockdowns. WTI crude oil neutral VAM still on a rising uptrend, with OVX oil volatility, continues to be on a rising uptrend as well. So that's why it's neutral and not bullish. As you can see, a lot of realized volatility here. That's the whole point of the process. When things are green, it's saying it's going up with low volatility, and you can have bigger position sizes as a function of that. Your risk budget, you can use more of your risk budget to allocate to the asset. When things are neutral, you can still be long, but the realized volatility is going to be higher. So you have to take down your overall exposure, your overall risk budget to this particular type of asset, because again, it's going to have a lot more semi-variance, which is downside volatility, if things go the other way. Again, this is about managing risk appropriately, not just YOLOing or all the other dumb shit that everyone's done in the last couple of years that's caused them to lose a shit ton of money this year. And part of my language, I apologize, won't be doing that again. Agricultural, Bloomberg Agriculture Index, that's neutral VAMs, still in a bull market here. Same thing with the realized vol. This, you can have more risk budget allocated to this than you can in this. As you can see, a lot more chop, a lot more semi-variance. Doesn't mean the price doesn't go up, but again, you need to understand that, hey, look, when things are neutral VAMs, it's not as bullish, it's not as rosy from a volatility standpoint, from a Sharpe ratio standpoint, as it's going to be when things are bullish VAMs. And then lastly, industrial metals, as I mentioned, broke down the bearish VAMs this week. Now it's at the upper boundary of its probable range here, as the range is shifted to a negative skew, minus 7.8% of downside versus 1.3% of upside. So with that, Darius Dale presenting our macro minute for Friday, May 20th, 2022. Everyone have a wonderful weekend out there. We'll catch you on Tuesday, because I'll be traveling on Monday. Cheers.